All right, so we're back. My name is Amar, and this is Kyle.
Hello?
And we're going to be going through the risk, or I guess like concentrated positions, and what it really means and what risks are intact there. So first, before we get started, we obviously, we got disclosures. So basically, this says that we haven't taken your accounts or your situation into account, and we're not giving advice. We're just giving broad education. Kyle, do you have anything to add to the lovely disclosure list?
You pretty much nailed it. That this isn't on the books. This isn't official. This is just merely a discussion between Amar and myself. And if you have any follow-up questions or anything that we can help with, always feel free to inquire. I'll include my contact information. Amar will have his. So
Yeah, cool. So let's get back to this. So I think there is, with equity compensation, specifically with companies, there is a concentration risk, right, Kyle?
yeah. So typically, we've seen it more over the last 15, 20 years than ever before, is the equity compensation being a big piece of even just average employees at tech companies.
Yeah, I think it's mainly tech companies that really drive this down to like engineers and other people. You used to be just executives, right? And now we're seeing it with more and more people. And there are different types, right? So there's RSUs, there's stock options. What else do you normally see?
Yeah, so it usually breaks down. There's three or four basic categories of stock options. There's restricted stock units, non-qualified stock options, incentive stock options, and sometimes there's employee stock purchase plans, or ESPPs. And all four of them have different tax treatment. And so
makes it hard, right?
it makes it hard. More common than not, I see RSUs as kind of the number one compensation vehicle for a lot of these tech companies. So if you're at Google or Facebook or Amazon or one of these tech companies where the stock price has gone up exponentially over the last 3 years, that's the most people that I work with, that's their compensation model. Just because it's and companies like it because it's the cleanest and easiest and predictable. They get to expense it right away, and they're in control of it. So
that's interesting to see that, right? I mean, if you think about it, when you get company stock, you're getting a portion of the company as like some sort of percentage ownership, right? Like, percentage is really small, but like, the idea is that everybody's going the same direction. But I think this really gives you some concern in the sense that you're putting your current income is based off of your company. You're putting savings, which is essentially your past income that you've earned, into the company. And then you're also putting future income into the company when you're getting these RSUs that have different vesting dates and et cetera. From a planning perspective, that's a lot of risk in that company, right? Like your past, present, and future income is dependent upon that company. Would you agree?
Yeah, absolutely. And especially, I think the last 3 to 5 years, if you've got an equity compensation, it's done nothing but benefit you if you have just held on for the most part. From what I've seen, just with the stock market at 35,000 and used to be at 10,000 not too long ago. Anybody that's held on to stock in that period of time has benefited tremendously. Well, that is going to change sometime in the future, right?
Stocks go up and down, right, Kyle? They don't go straight up. It's not like to the moon like this. All these what do you call memes? Stocks. Everybody's saying to the moon. It's not like that. Things go up and down, and you have to be cognizant of that, right? When you're thinking about your personal situation as well as kind of where you are in that timeline of your own life, right? So if you're early in your career versus if you're late in your career, like, can you afford to take that much risk, right?
Yeah, and that's you kind of hit the nail on the head. It comes down to risk, right? How much money do you want tied up in this company? What would you do if it all went away, right? Is all of your net worth tied in this stock, and then are you going to be able to gain that back someday, and you have to. Those are all the things you have to weigh in having a concentrated position, like you mentioned, in a single company. A financial advisor like yourself and a tax advisor like myself, usually, we recommend that you don't have all of your eggs in one basket.
Yeah. And it's hard, right, Kyle? You would agree with most clients that you talk to, it's hard to separate from the company because there's this like commonality or normalcy bias, I would say, like that the company, right? Like if you're an executive of the company, you'll know the things that you're working on. So you kind of feel like you're that these are all things that you would invest in, right? You're
so financially invested, you're so emotionally invested, your life is invested in this company. This is why they offer stock options, is to make sure you're more of a team player and you have a vested interest in the company benefiting.
Yeah, exactly.
And so it's hard to detach from that, right? But as you and I know, there's lots of ways to make money in the stock market.
Yeah.
There's no reason to put yourself up for that much risk. Especially if you kind of hit let's say you hit $3 or $5 million in net worth through your stock options and you did really well.
Yeah.
Well, you want to lock that in, right?
Yeah, you need to take the risk off the table, right? Like the opportunity for it to grow more, will that sizably impact your life or your goals, your financial goals, right? And I think that's one of the hardest things that I've worked with clients over the years is how do you define what's enough, right? Because it's just using
that never stops, Amar.
yeah, right.
A little bit more.
Yeah. So one of the things that I guess we should talk about is like the taxes around these concentrated positions. But I guess there's each one has its own different tax, like what do you want to call it? Not rate, but like method of what you use. Yeah. So let's start with like RSUs, for example.
So yeah, like I mentioned, RSUs are the most straightforward. They come in as ordinary income. So it is just like the company wrote you a check. That's exactly how it's taxed. Because it's because you're employed there is the reason they granted you these RSUs and you vested into these RSUs. And so typically at grant, there are no tax implications. And then you will vest over a period of time, which usually maybe a two-year schedule, 4-year schedule, depends on what the grant is. And when every period you vest is just like if the company wrote you a check, this is how it's taxed. Now, how it's withheld is another issue, is because in 2017, during the Trump tax cuts, they took the bonus compensation withholding rate from 25 down to 22%. And so I've seen a lot more clients the last 3 years kind of get surprised at the end of the year when they owe more after they've already vested in their RSUs. They haven't sold any of them, but they're taxed at maybe a 35 to 37% tax rate, but they're only withheld at 22. Mm. So a 10 to 15% delta on $1 million. Well, that could be a lot of money. So
a lot of money. And it's funny because like when we see these, like most people getting this equity compensation are higher than that 22% rate. Would you agree? Like the next dollar earned is going to be higher than that 22% rate for most people getting equity compensation.
Yeah, most of my clients would definitely fall in that bracket. So
yeah. So what else should we talk about? So we did RSUs. Maybe we leave it to RSUs because then we can do another video on the other different things and we can dive into more details. Is there anything else?
I think that sounds good. Yeah, I think
right?
If I keep going, everyone's going to drown out here. So
yeah. So thanks for listening to us. I think that if we peel back and look at the key points here, is that from a planning perspective, you don't want your current income, your past income, and your future income to be dependent upon one company. You want to take some risk off the table. Second thing was only you can define what is enough, right? That's something that you have to work with a planner, tax professional, figure out what your needs are, and then you can say, all right, I've reached my enough. or my number, and you want to start taking risk off the table. And the taxes, I mean, that's a big one. If you're only withholding 22%, expect another tax bill at the end of the year, right? So I think that was good. If you have questions or if you have any comments, please put it below. Both Kyle and I read them, and we try to do these videos to help you guys. So if you have any ideas, just let us know as well. Thank you.
Yeah, thanks, Amar. I think that was a great summary. And if you have any questions, tax questions, financial questions, we're here for you guys. So I appreciate everybody watching this, and we'll be in touch soon.
All right.
All right. Bye-bye.
There.